head of macro strategy APAC at Wells Fargo Securities, joins us with his take on things. Chidu, lovely to have you on the show. Thank you very much for your time. Whatever I said on the dollar index, the fact is that it did bounce back from 14-month lows. I guess that's just some relief that traders found in the fact that, yes, the rate cuts are out. Yes, the Fed has started with 50 basis points, and now you need to kind of calibrate from here what this means for the dollar index. But my question to you is, invariably through cycles, a good economy or a bad economy has been dollar positive, because a bad economy means more stimulus, which is, again, supportive of the dollar. And in a rising interest rate environment, it's the yield prospects that drives money into the dollar. So how are you seeing the dollar's case, investment case from here?
Right. That's a very important question, but good morning. Thanks for having me back again. So the Fed finally began its rate cutting cycle that markets have been waiting for 18 months now, a bit longer. And they began with a bang, 50 basis points, but the forward-looking guidance is a little bit more cautious. They've said the dot plots indicate another 50 basis points possibly for the rest of the year. The labor market prints will become very important in directing whether it's 25 or 50 at each of the meetings. We have 2 more labor market prints before the next meeting, and the Fed's made it clear that the labor market is quite important in its decision making. But looking at the dollar itself, one, on the rate differential, we've seen across the board rate pricing move downwards over the last few weeks, led by dollar rates. And going ahead, you will see quite a bit of that as well. So you will see over a medium-term horizon, the dollar being slightly softer as the rate differential advantage slows down, as the growth outperformance slows down. But in the near term, we're not very surprised by a pickup in dollar, because the focus will then move from policy to risk events and politics over the next 3 to 4 months. And you have quite a few of the risk events there. And uncertainty in the outcomes there, potential for a growth slowdown in the global economy, and you still have an anemic China growth to boot in the global space. All of that means that risk premia on the dollar seems to be a little underpriced, and we do see a pickup in dollar strength against specific pairs going forward over the next 3 months.
What does that mean for regional currencies, given some of the appreciation we've seen in recent weeks?
That's actually after the Fed rate cut. Asian central banks have gotten a little bit more degrees of freedom. That has certainly increased. Over the last, say, 3 to 4 years, they've been forced to make policy more on external headwinds rather than domestic factors, and they will get a little bit more of that independence back, of the degrees of freedom back. And as you get that back, you will start to see this divergence emerge between the Asian central banks, and we've written about that in a note a couple of weeks back. You will have on one end central banks like the Philippines, Indonesia, which have already cut rates and which could be cutting rates very significantly aggressively over the next few months, possibly the most significant rate cutters in the region. You will have the likes of India and Korea, which will probably cut around 75, 100 basis points, not dramatically, but enough, and certainly not in pace with the Fed. And on the other tail, you will have the likes of Malaysia, Taiwan, Australia, which probably would not cut at all this year. And Taiwan could possibly cut only by 25 basis points sometime in 2025. So you will have this divergence emerge across Asia, which will then give you opportunities to play relative value trades within the region. And to boot, you will also have this divergence between the Northeast Asian players, which are dependent on semiconductors, dependent on global growth, and they could see a bit more of a rally. The likes of Korean won and Taiwan dollar could see a significant rally because they've been quite underpriced. And 2, a little bit more volatility depending on how growth, tariff expectations, US elections, all of that pans out over the next 3 months.
That's a really good take. I'm keen to get your thoughts on China specifically, given that the Fed has arguably just made the PBOC's job a little bit easier with that LPR decision tomorrow. But I'm just reading on Reuters here some commentary from their analysts suggesting that, you know, the Chinese currency might not do what it normally does if they were to cut that rate potentially tomorrow on the 1 and the 5 year, as it normally does. And they say the first reason is because the market's already crowded with these bearish yuan bets, but also because of that widening yield differential, the bond yield gap. So do you agree with that take, and what are we likely to see?
Yes. So one of the questions we've been asked quite regularly more recently is, could we see a carry unwind in the yuan, just like we saw in the yen? And we don't think so for 3 reasons. One, China growth is still quite soft, and there is a lot more to go there. You see pockets of weakness pretty much across the board, irrespective of what you look at. Domestic consumption is soft, fixed asset investment is soft, housing markets being soft, equity markets soft, and so on. Second, a lot of the bearish yuan trades are held by corporates and households in China versus fast money in yen, which is more sticky in the case of the CNH versus the yen, so it's much harder to unwind. And 3, you also have this election, US election uncertainty over the next 3 months. And depending on how that plays out, you could potentially have increased tariffs, increased trade restrictions, and that risk premium, which will mean that the dollar will still remain a safe haven, but particularly for domestic asset holders. So we don't think that the CNH is going to be dramatically appreciating. But that being said, the worst is possibly over for the CNH. We've seen dollar CNH trade right at the midpoint of the fixing band, and we don't see too much pressures one way or the other. Maybe underperforming regional currencies on a dollar bearish story, and outperforming if you do have some more dollar strength with the PBOC essentially slowing down volatility there.
Okay, so I'm reading your notes where you're saying the Reserve Bank of Australia is to stand pat on rates. The RBNZ is to cut by 25 basis points. Further, that is. RBI not in a hurry to cut. That's exactly what I got from the governor as well in my exclusive interview. Bank of Korea to cut between 75 to 100 basis points. You alluded to that as well. And of course, you spoke about the Taiwanese dollar, and you also spoke about Bank of Thailand to cut rates in Q4. I want to understand from you, a lot of the liquidity move in this part of the world really is not predicated on what these central banks do, but what the BOJ does tomorrow and then towards the end of the year. What's your sense?
So one, we think that and this is market consensus now, the BOJ is comfortable with how things have panned out in terms of inflation, in terms of wage growth and so on. They are confident that they can reach their inflation target. And wage growth has picked up quite significantly, not just in nominal terms, but in real terms, which is what the BOJ was really after, which is what gave them the confidence to move all these 2 times this year, ahead of what markets are expecting. Given what they've done already, and given potential volatility now right after the Fed, if the BOJ goes again, we don't think that they're in a hurry to move just as yet. They could move again, possibly later this year, but not in the offing right away. But what will be important for the yen is less what the BOJ does. The BOJ has stated that they want to move towards neutral, which is possibly around the 1% handle. So rates could go there maybe over the next 12 months. But the yen has been driven more by dollar rates differential and the global growth outlook. And you did see over the last, say, in Q2 really, where bearish yen trades did spike up quite significantly. You've seen a lot of washout of all of that. So the yen positioning is much cleaner, with speculative positions being washed out on the carry unwind. So you don't see that much more weakness on the yen. But that being said, we don't really see that dramatic strength on the yen as well. Probably range bound near term, maybe 139 to 143, 145. A lot predicated on 2 factors. One, what happens with the US elections and how global growth expectations and sentiment plays out.
Okay.
That is where we see a difference between the yen and the rest of the Asian complex, where the yen benefits from a global growth slowdown being generally softer, being a risk-off currency, versus the rest of Asia, particularly Northeast Asia, could underperform, especially those dependent on trade.
Got it. Chidu, thanks very much for tying in the Forex angle to the story that we are trying.